All right, let's jump into today's deep dive. We're going to be looking at the PAI morning briefing for December 11th, 2024. Get ready, because we've got some pretty interesting market trends and financial news to break down.
Always exciting to see what's shaking things up out there. And this briefing definitely has a few surprises up its sleeve.
For sure. Let's start with the market overview, shall we? The Nasdaq had a bit of a dip, but then you've got Bitcoin and Ethereum rallying. It's like they're not even on the same page, right?
Yeah, it really highlights how different forces are at play in these markets. Tech stocks like those on the Nasdaq, they're often pretty sensitive to interest rate trends and how people are feeling about the economy in general. But cryptocurrencies, they tend to dance to the beat of their own drum, reacting more to things like regulations and adoption. So yeah, their movements aren't always going to be in sync.
Interesting. So while the Nasdaq is down, the S&P 500 and the Dow Jones, they kind of just, landed softly.
Yeah.
Does that tell us anything about the overall market mood?
I think it suggests a bit of underlying caution. But the broader market, like what the S&P 500 and Dow Jones represent, they seem a bit more resilient. Maybe because they're spread across so many different sectors.
Speaking of different sectors, let's talk energy for a minute. OPEC, the oil cartel,
Hmm.
they decided to lower their oil demand forecasts.
Yeah.
So does this mean the world's finally kicking its fossil fuel habit?
Well, it definitely shows a shift in the energy landscape, that's for sure.
Yeah.
This lower demand projection from OPEC, it could mean a couple of things. Maybe renewable energy sources are finally gaining some real traction, or perhaps global economic uncertainties are putting a damper on consumption. It's not a simple story, though.
Makes it even more interesting, right? Especially with Exxon going all in on the Permian Basin, dropping a cool $140 billion to ramp up oil and gas production. Talk about betting against the trend.
Well, it might not be as straightforward as it seems. Exxon's move kind of shows us how complex this whole energy transition really is. Even with renewables on the rise, we can't just flip a switch. Oil and gas, they're still crucial parts of the energy mix, and they probably will be for a while. Looks like Exxon's playing the long game here.
So more like a slow burn than a sudden switch. Okay, let's switch gears and talk about interest rates. Treasury yields are going up, and everyone's on the edge of their seats waiting for the Consumer Price Index report. Now, just to refresh everyone's memory, can you remind us what these are and why they've got everyone so nervous?
Okay, so think of Treasury yields like a thermometer for how much it costs to borrow money in the economy. When those yields go up, it usually means investors are thinking inflation is going to rise or that the Federal Reserve is about to tighten things up.
And the Consumer Price Index, that's how we measure inflation, right?
Exactly. It tracks how the prices of everyday stuff, the goods and services people buy, how those prices change. The Federal Reserve, they use this data to decide what to do about interest rates.
So if the CPI is high, the Fed might raise interest rates to try and cool things down.
That's the basic idea. The tricky part for the Fed is to keep inflation under control without putting the brakes on economic growth. It's a real balancing act.
It's all connected, that's for sure. Now, this briefing takes us on a little tour of some interesting corporate happenings. We've got Patterson going private in a massive deal, Krispy Kreme dealing with a major cyber attack, and Macy's, well, they're having some accounting struggles. What do these stories tell us about the business world right now?
They really show us the kind of mix of challenges and opportunities that businesses are facing these days. The Patterson deal, it reminds us how big of a role private equity is playing, especially when the markets are kind of unpredictable. Then you've got the Krispy Kreme cyber attack, which is a big wake-up call about how vulnerable businesses are in this digital age. And Macy's situation, it really underscores how important it is for companies to have accurate forecasts and be transparent with their finances. If they want to keep investors happy, that is.
Talk about a dynamic environment. And speaking of dynamism, the tech world is buzzing about possible changes to the H-1B visa program. Lots of people are worried, and I think it's important to understand why.
Oh, absolutely. The H-1B visa, it's like a lifeline for the tech industry. It's how companies bring in talented people from overseas. Any changes to the program, well, it could have a ripple effect that goes way beyond tech. It could impact innovation and even the whole U.S. economy.
So it's bigger than just a tech industry problem.
Exactly. You see, if companies can't get the talent they need, it's going to hold them back from creating those new products and services, which could then slow down economic growth. It's a big deal.
Definitely a story to keep an eye on. Now, this next one really caught my attention. Kathy Wood's fund is making a big bet on what they're calling a Trump 2.0 scenario. Sounds intriguing, but gotta admit, I'm not entirely sure what that means.
So Kathy Wood, she's a pretty well-known investor, really focused on those game-changing technologies. Her fund, it looks like they're betting on a potential shift in the market, maybe in policies that kind of mirror what we saw during the previous Trump administration. Think deregulation, tax cuts, and real focus on domestic industries.
So they're looking for companies that would thrive in that kind of environment. What kind of companies are we talking about?
The briefing mentions cryptocurrencies, companies connected to Elon Musk, and defense stocks. Those are all areas that could potentially benefit from those kinds of policies. It's a bold move, that's for sure. Only time will tell if it's a winning bet.
Definitely a strategy to keep tabs on. Now, this one's a real head-scratcher. The briefing highlights a study that claims the traditional 60/40 portfolio is dead. That's like investment heresy, isn't it? Is there anything to this, or is it just someone trying to be controversial?
It's definitely a thought-provoking idea. The 60/40 portfolio, 60% in stocks, 40% in bonds, it's been the go-to for long-term investors for ages. But this study, it argues that in today's world, putting all your eggs in the stock basket, especially international stocks, might actually be a better way to save for retirement.
So ditch the bonds entirely. Seems kind of risky, no?
It definitely comes with more ups and downs, but the study says that over the long haul, the potential for bigger gains outweighs the risk. Of course, before making any drastic changes, you got to think about your own risk tolerance and what you're aiming for with your investments.
Always a good reminder. Even long-held investment wisdom is getting a second look these days. Speaking of second looks, the briefing mentions that even Tom Lee, the guy known for his optimistic outlook, he's sounding a bit cautious about what's next for the market. Should we all be heading for the hills?
Well, Tom Lee's caution, it's definitely something to pay attention to. It reminds us that markets move in cycles. And after two pretty strong years for the S&P 500, it wouldn't be surprising to see things level out a bit or maybe even pull back. It doesn't necessarily mean a crash is coming, but it suggests investors should be ready for some bumps in the road and maybe adjust their expectations for the near future. It's always smart to be prepared, especially when it comes to the markets.
Absolutely. This PAI morning briefing, it's really got us thinking. It feels like the market's at a crossroads, doesn't it? So many things pulling it in different directions.
Yeah, you hit it right on the head. We've got all these changes happening in tech and energy, plus the possibility of new policies and all the economic uncertainty around the world. It's a lot to take in.
It really is. And it makes you realize how crucial it is to stay informed, to be able to adapt your strategy as things change.
Couldn't agree more. Knowledge is power, especially when things are moving as fast as they are now.
Okay, let's circle back to that study about this 60/40 portfolio. It's a pretty radical idea to just completely ditch bonds. Can you break down the logic behind that?
Well, the 60/40 portfolio, it's been the gold standard for decades. But it's facing some valid criticisms these days. Bonds, they've always been seen as that counterbalance to stocks, that thing that provides stability when the market takes a dip.
Right, because bonds tend to be less volatile.
Exactly. But here's the thing. With interest rates so low right now, bonds just aren't providing the same level of stability they used to. And then you've got the possibility of higher inflation down the line. Holding a big chunk of your portfolio in bonds could actually mean losing purchasing power over time.
So they're saying that in this particular economic climate, sticking with just stocks, especially international ones, might be the way to go for long-term growth.
That's the gist of it. And they're not just saying any stocks either. They really emphasize the potential of international stocks.
Why international stocks specifically?
They argue that international markets, they give you more diversification, and you get a chance to tap into growth in those emerging economies. It's about spreading your risk and potentially snagging those higher returns over the long run.
Definitely an interesting perspective, but I'm sure plenty of investors are still a bit hesitant to completely abandon that 60/40 approach.
Of course, it's not a one-size-fits-all kind of thing. The best approach for any investor, it always depends on their individual situation, their risk tolerance, their goals, all of that.
Always good advice.
Oh.
Now, let's zoom out a bit and look at the broader economic picture. We've talked about potential changes to the H-1B visa program and the possibility of a Trump 2.0 policy environment. Those are some pretty big unknowns hanging over the market. How are these uncertainties affecting investor sentiment?
Well, it creates this sense of caution, but also, for some, a sense of opportunity. The H-1B visa situation has a lot of tech companies on edge. It could really impact their ability to attract the best talent. And the potential for a shift in policy back towards something like what we saw under the previous Trump administration, well, some investors are trying to position themselves to capitalize on that. Figure out who the winners and losers might be.
It's like trying to predict the weather while a hurricane's forming off the coast.
That's a perfect analogy. You've got all this potential energy building up, and it's hard to say exactly what direction it'll go in.
But some people are trying to figure out how to ride those waves, so to speak, like Kathy Wood's fund with that Trump 2.0 bet.
Exactly. They're looking at sectors that could benefit from things like deregulation, tax cuts, and a focus on domestic manufacturing. So things like cryptocurrencies, those space exploration companies, defense contractors, that kind of thing.
It's a bold strategy, that's for sure. But like you said earlier, only time will tell if it actually pans out.
That's the thing about the market. It's constantly in motion, always reacting to new information.
And speaking of reacting to new information, let's revisit that whole 60-40 portfolio being challenged.
Yeah.
What kind of information is making people question this long-standing investment strategy?
I think a big part of it is the interest rate environment we're in right now. With rates at historic lows, bonds just aren't yielding much. In some cases, you might not even keep pace with inflation.
So you're essentially losing buying power if you've got a lot of your money tied up in bonds in that scenario.
That's the risk. And with inflation potentially going up in the future, some investors are starting to wonder if it makes sense to have so much of their portfolio in assets that might not deliver big returns.
Makes you think maybe the 60-40 approach, which was designed for a different economic landscape, needs an update for today's reality.
That's the heart of the argument. It's not about ditching bonds entirely. It's about finding the right balance for your portfolio. Something that aligns with your risk tolerance and your long-term goals, given where the market is right now.
It's a good reminder that we can't just blindly follow the old playbook. We got to be adaptable, adjust our thinking as the world changes around us.
Couldn't agree more. It's about being informed, understanding what forces are at play, and being willing to shift gears if needed.
So for someone listening to this thinking, okay, maybe I need to rethink my portfolio, what would you suggest? Where should they start?
First things first, take stock of your own situation. Figure out your financial goals, your time horizon, how comfortable you are with risk. Then do your homework. Read up on investing, listen to podcasts like this one, maybe even talk to a financial advisor.
It's all about arming yourself with knowledge so you can make smart decisions.
Exactly. And don't be shy about asking questions.
Yeah.
Talk to financial advisors, friends, family, anyone who's got some experience with investing.
Build a network of people who can offer guidance and support.
And remember, investing is a marathon, not a sprint. You're going to hit some bumps along the way. The key is to keep your eyes on the prize, those long-term goals, and not get thrown off by every little market wiggle.
Have a plan and stick to it even when things get a little rough.
Exactly. And be willing to adjust that plan as you go along. The market never stands still, so your investment strategy needs to evolve with it.
It's all about being adaptable and staying informed.
Absolutely. And most importantly, don't wait to get started. The sooner you jump in, the sooner you can start building your wealth and reaching those financial goals.
Great advice.
Yeah.
Now, let's go back to that idea of a potential Trump 2.0 policy environment. Can you give us a bit more detail on what specific policies might be implemented and how those policies could affect different parts of the market?
Sure. One thing that comes up a lot is deregulation. Under the last Trump administration, there was this big push to cut back on regulations in a bunch of industries like finance, energy, healthcare. That kind of approach, if it happens again, could benefit companies in those sectors. It would lower their costs and potentially boost their profits.
So investors might want to look for opportunities in those areas.
Possibly. But it's important to remember that deregulation can be a bit of a double-edged sword. It can definitely stimulate the economy and create opportunities for businesses, but it can also mean less protection for consumers and maybe even increase risk in the system overall.
It's a matter of weighing the potential benefits against the risks. What about tax cuts? That was another big thing under the previous Trump administration. How could those impact the market if they were brought back?
Tax cuts can give the economy a boost by putting more money in the hands of people and businesses. That can lead to more spending and investment, which then helps corporate profits and pushes stock prices higher.
So investors might want to look at companies that would benefit from that extra spending, or maybe companies that are planning to invest a lot of capital.
That's one way to look at it. But the impact of tax cuts is complicated. It depends on a bunch of factors, like how the cuts are structured, how they're paid for, and the overall state of the economy.
It's never as simple as it seems. And what about that focus on domestic industries you mentioned? How might that translate into investment opportunities?
Well, if there's this big push to ramp up domestic manufacturing and reduce our reliance on imports, it could create some interesting opportunities for companies that operate in sectors like manufacturing, infrastructure, energy production.
Basically, companies that produce stuff right here in the U.S.
Exactly. We're talking traditional manufacturing, renewable energy, even things like semiconductor production, which has become really important for national security and economic competitiveness.
Sounds like investors have a lot to think about with this potential Trump 2.0 scenario. It's not just about jumping on any stock that seems vaguely related. It's about really understanding the specifics.
You got it. It's about being selective and strategic, and realizing that even if these policies do get implemented, the impact on the market won't be instant or uniform. There will be winners and losers, and it's up to each investor to do their research and make decisions based on their own goals.
It's all about being an informed and savvy investor. Now let's talk about something else we touched on earlier, how vulnerable businesses are in our increasingly digital world. That cyber attack on Krispy Kreme, it's a stark reminder that even companies known for their donuts aren't immune to these threats.
It's a real wake-up call for businesses of all sizes. Cybersecurity, it's not just an IT issue anymore. It's a business risk that needs to be taken seriously at the very top.
Absolutely. The consequences of a cyber attack, they can be devastating. You're talking financial losses, damage to your reputation, legal problems, even regulatory scrutiny.
It's not just about protecting your data anymore. It's about protecting your brand, your customers, your entire business.
So what can businesses do to minimize these risks? What are some key steps they can take to strengthen their cybersecurity?
There are several things they can do, but the first and foremost is to have a solid cybersecurity strategy in place. That means strong passwords, multi-factor authentication, keeping software up to date, training employees, and having a plan for what to do if something does happen.
So it's not just about the technology, it's also about the people and the processes.
Exactly. Technology is important, but it's just one piece of the puzzle. You got to make sure your employees know how to stay safe online and what to do if there's a problem.
Create a culture of cybersecurity awareness throughout the company.
Exactly. And realize that cybersecurity isn't a one-and-done kind of thing. The threats are constantly evolving, so businesses need to be constantly adapting and improving their defenses.
It's a race against the bad guys, in a way.
You could say that, but it's not about being paranoid. It's about being proactive, taking the necessary steps to protect your business.
Good advice. Now let's shift to another company that made headlines in this briefing, Macy's. They've got some accounting issues that have investors a little worried. Can you tell us what's going on there?
Sure. Macy's recently reported an earnings miss, which means their profits weren't as high as analysts expected, and that's led to some scrutiny of their accounting practices and concerns about how accurate their financial reporting really is.
So it's not just about missing those earnings targets. It's about the possibility of bigger problems with how they're managing their finances.
That's the worry. Investors want to be confident that the numbers they're seeing actually reflect how the company's doing. If there are doubts about the integrity of a company's accounting, it can really damage investor trust and lead to some wild swings in the stock price.
It really highlights how crucial transparency and accuracy are when it comes to financial reporting.
Absolutely. Investors rely on companies to be upfront and honest with their financial information so they can make informed decisions. When that trust is broken, it can have serious consequences for everyone involved.
It's a lesson that all businesses, big or small, need to take to heart. Integrity and transparency are everything when it comes to finances.
Couldn't agree more.
Now, I want to circle back to the energy sector for a second. We talked about the global shift towards renewable energy and what that means for those traditional oil and gas companies like Exxon. But what about the opportunities this transition creates?
That's a great point. This energy transition, it's not just a threat to the old guard, it's also a catalyst for innovation and new ways of doing business. We're seeing a ton of investment pouring into renewable energy tech, everything from solar and wind to battery storage and electric vehicles.
So for investors, this could mean looking beyond those traditional energy companies and exploring the renewable space.
Absolutely. There are more and more companies popping up that are focused on developing, producing, and distributing renewable energy technologies. And as the demand for clean energy keeps growing, these companies are poised for some serious growth.
It's like a whole new world for investors to explore.
In a lot of ways it is, and it's not just about backing specific companies, it's about investing in a more sustainable future.
That's a powerful way to think about it. Now let's bring it back to the individual investor for a minute. We've covered a lot of ground today, from market trends to economic indicators, investment strategies, even geopolitical risks. It can feel a bit overwhelming, right?
It definitely can. The financial world, it's complex and it's always changing. But that's also what makes it so fascinating.
It's like trying to solve a puzzle where the pieces are constantly changing shape.
I like that. But even though it can be challenging, you don't need to be a financial guru to be a successful investor.
So what advice would you give to someone who's feeling a bit lost, bombarded by all this information and not sure where to even begin?
Start by educating yourself. Read books, articles, websites about investing. Listen to podcasts like this one. Maybe take some online courses if you want to delve deeper into certain topics.
Build up that knowledge base.
Exactly. And don't be afraid to ask questions. Talk to financial advisors, friends, family members, anyone who might have some experience in this area.
Create that network of support and resources.
And remember, investing is a journey, not a destination. You're going to have some wins and losses along the way. The key is to stay focused on your long-term goals and not let the market's daily ups and downs throw you off course.
It's about having a plan and sticking to it, even when things get a little rocky.
Exactly. And don't be afraid to tweak that plan as you go along. The market's always changing, so your investment strategy needs to keep up.
Stay adaptable and informed.
Precisely. And most importantly, just get started. The sooner you start investing, the sooner you can start building your wealth and reaching your goals.
Great message to end on.
Thanks, I appreciate it. I've really enjoyed our conversation today.
Me too. Always learn so much with these deep dives.
I feel the same. It's great to have a chance to really dig into these important topics and share what we know with the listeners.
Now, before we wrap up, I want to go back to that energy transition and the opportunities it creates for investors. We talked about renewable energy companies, but are there other areas within the energy sector that investors might want to consider?
That's a great question. And yes, there are. One area that often gets overlooked is energy efficiency. As the world focuses on lowering its carbon footprint, there's this growing need for technologies and services that can help businesses and people use energy more efficiently.
Like smart grids, those building automation systems, energy-efficient appliances, that kind of thing.
Exactly. Those technologies can help cut down on energy consumption, lower costs, and reduce greenhouse gas emissions. And as we push for greater energy efficiency, companies operating in this space, they're likely to see some major growth.
It's like investing in sustainability and efficiency all at once.
Well put. And it's not just about doing good for the planet, it's also about making smart investments that can deliver strong returns.
And a win-win situation.
Precisely.
Now let's talk about something we haven't really touched on yet, inflation. It's been a big concern for everyone, both investors and consumers, and it's something we're keeping a close eye on. What are your thoughts on the current inflation outlook?
Inflation has been pretty stubborn lately, and it's being driven by a few different things, like those supply chain disruptions, rising energy prices, strong consumer demand. It's a complicated problem with no easy answers.
So what can investors do to protect themselves from the negative effects of inflation?
There are a few strategies they can consider. One option is to invest in assets that tend to do well when inflation is high, like commodities, real estate, and certain types of stocks.
Assets that have real value and tend to increase in price along with inflation.
Exactly. Another strategy is to focus on companies that have strong pricing power. Those companies that can raise prices without losing customers.
The ones that can pass on those increased costs without seeing demand drop off?
Precisely. Those companies are in a better position to deal with inflationary pressures and maintain their profitability.
It's all about finding companies that can adapt to changing economic conditions.
Exactly. And it's important to keep in mind that inflation tends to go in cycles. It's not going to stay high forever.
So while it's important to be aware of the risks and take steps to mitigate them, we also don't need to panic.
Exactly. It's about finding that balance between being cautious and seizing opportunities.
Great advice. Now, I want to shift gears one last time and talk about something that's been on my mind. Technology in the financial markets. It's really changing the game, isn't it? Everything from how we invest to how companies operate.
It's a complete game changer. We're seeing incredible advances in things like artificial intelligence, machine learning, blockchain technology. All of these are having a huge impact on the financial industry.
So it's more than just online trading and mobile banking apps. It's about fundamental changes in how the whole system works.
Exactly. Technology is making new business models possible, automating processes, and creating efficiencies that we couldn't have imagined before.
It's like the financial world is having its own digital revolution.
You could say that.
Yeah.
And it's creating both opportunities and challenges for investors and companies.
So how can investors stay ahead of the curve? How can they make sure they're not getting left behind in this rapidly changing technological landscape?
One important thing is to stay up to date on emerging technologies and how they're affecting the financial markets. Read articles, go to conferences, talk to the experts.
Keep your finger on the pulse of innovation.
Exactly. And don't be afraid to experiment. Try out new investment platforms, explore different types of assets, maybe even invest in those companies that are leading the way in tech innovation.
It's all about embracing the future and being open to new possibilities.
You got it. And remember, technology is just a tool. It can be used for good or for bad. It's up to us to make sure it's used responsibly and ethically.
That's a crucial point.
I agree. We need to make sure technology is being used to create a financial system that's more inclusive, more sustainable, and fairer for everyone.
Well said. Now, before we wrap up this deep dive, I want to go back to that idea of staying informed and adapting to a constantly changing market. It can be pretty overwhelming at times. What are some practical tips investors can use to manage the information overload and cut through the noise?
That's a great question. One strategy is to be really picky about the information you consume. Stick to reliable sources of financial news and analysis.
Avoid those clickbait headlines and sensationalist reporting.
Exactly. Find sources that provide a balanced and insightful perspective on the market.
Good advice. What about managing all the different pieces of information we're constantly bombarded with? News articles, social media posts, emails from financial institutions. It's a lot.
It's important to have a system for filtering and organizing that information. You might make a list of trusted sources that you check regularly, or use a news aggregator to personalize your newsfeed.
Find a system that works for you and helps you cut through the clutter.
Exactly. And don't be afraid to take a break from it all sometimes. It's easy to get caught up in those daily market swings and lose sight of the bigger picture.
Keep things in perspective, and don't let the noise distract you from your long-term goals.
Exactly.
Now, before we wrap up this deep dive, I have one last question for you. We've talked about so many different factors that influence the market. Interest rates, inflation, geopolitical risks, technological advancements. If you had to choose one thing that investors should be paying the most attention to right now, what would it be?
Oh, that's a tough one. But if I had to pick, I'd say it's how interest rates, inflation, and economic growth are all interacting with each other.
Can you expand on that a bit?
Sure, we're in a really unique economic situation right now. Inflation is high, interest rates are climbing, and economic growth is slowing down. It creates a lot of uncertainty for investors.
So it's about understanding how these factors are all connected and how they might impact different parts of the market.
Exactly. Investors need to be watching how central banks around the world are handling these challenges and how their policies might impact interest rates, inflation, and economic growth in the coming months and years.
Like watching a chess game, where the pieces are constantly moving and you're trying to figure out what the next move will be.
That's a great way to put it. It's a complex and ever-changing environment, so staying informed and adaptable is essential.
Well said, expert speaker. Thank you so much for sharing your insights with us today. It's been a truly enlightening deep dive.
It was my pleasure. I always enjoy these conversations.
And to our listeners, thank you for joining us on this exploration of market trends and financial news. Remember, knowledge is power, and the more you know, the better equipped you'll be to navigate the complexities of the financial world and reach your financial goals.
Couldn't have said it better myself.
Now, before we sign off, I want to leave you with one final thought. In a world that's changing so rapidly, with information coming at us from all directions, it's more important than ever to stay curious, keep learning, and adjust your approach as needed. The financial markets are full of both opportunity and risk, and the more you understand, the better prepared you'll be to make smart decisions and achieve your financial dreams.
Great advice.
Until next time, stay informed and keep exploring.
Yeah, so much to process. But that's what we do in these deep dives, right? We break it down piece by piece.
Absolutely. It's all about demystifying the financial world, helping people understand what's going on so they can make good decisions. Couldn't have said it better myself. So as we wrap up our look at this PAI morning briefing, any parting thoughts for our listeners as they navigate the world of markets and finance?
Well, one thing this briefing really drives home is the importance of staying informed and being ready to adjust your course. There are a lot of moving parts out there, like we've discussed, but that also means opportunity. So what will you explore further after today's deep dive? Maybe that Trump 2.0 portfolio idea got you thinking. Or maybe you're ready to challenge that traditional 60-40 rule. Don't just let this information sit there, take action, dig a little deeper, and make it work for you.
That's a great takeaway. Thanks for joining us on this deep dive, everyone. Until next time, stay curious and keep exploring.